what's up, everybody? It is mid-November now. This is the week of November 17th. Thanksgiving is next week. This is unbelievable. I kind of asked, where does the time go? But here we are. We're back again with another weekly market update for us. Here we are going at the close of the year. And it's been fun in markets, to say the least. Volatility is back to the downside. We're seeing lofty pullbacks in a huge number of names across the board. And it's a lot to digest. And really how I want to frame this conversation, or I want to put the context of this market sell-off is what are the keys for 2026, right? Is this the beginning of uncertainty and us missing the mark with just equities as a whole? Or is this just a much needed pullback in stocks after nothing but straight up since the Liberation Day lows of April, right? So what I want to focus on this call with is really just the early keys to 2026. It's a year that could easily be defined by a few different words, not limited to tariffs, technology, more broadly, just uncertainty. Capital markets have plugged along splendidly up until last week. Despite a near bear market correction in April, the S&P 500 and the US stocks more broadly have powered higher, hurdling pretty much every obstacle thrown their way this year without any interruption. Bond markets have also done more than hold its own. While outside of markets, the American economy has displayed resilience as well amid a challenging backdrop. So as we're at the end of 2025 here, we're going into our final 100-day stretch. The market is already beginning to turn forward and attempt to reconcile what market drivers could remain in place and what could change in the first year or the first half of the new year to start this back half of the decade. So just, in a nutshell here, where I think the markets are trying to now say, all right, not that this year's in the rear view, but from Thanksgiving on, corporate America, that's a wrap, right? Outside of the retailers selling through the end of the year. Most of the economy here is now really starting to think for 2026. So the first thing I want everyone to think about here is with equities and what is the economy going to look like? Are we going to get a resilient economy? Are we going to get some fiscal stimulus? How are we going to hit these lofty earnings targets hit by corporate America? And to put it as plain English as I can, the economy will benefit from fiscal support through 2026. The Federal Reserve is signaled that they're going to start continually cutting rates. How and how much is up for debate, but we know for certain that rates are going to be cut. They've mentioned that the Federal Reserve is going to stop quantitative tightening. They're going to stop and potentially resume quantitative easing. And most notably, the big, beautiful bill that was passed this year, the legislation is expected to boost corporate profits and help corporate America sustain mid-single digit revenue growth, specifically with the deep depreciation aspects that were rolled into this thing. So good news there. Good news looking forward here, right? The biggest thing is that the AI investment cycle, if we want this to continue, needs to justify its valuations, and I would say this is by far the biggest risk to markets going forward. AI is going to remain the most powerful force shaping markets. These hyperscalers that include Alphabet, Amazon, Meta, Microsoft, Oracle are expected to boost AI-related capital expenditures to $520 billion, which is a 30% increase from year over year. And now we're starting to see them fund this through debt and not just corporate profits. But the bottom line is these companies are going to continue to plow money into AI infrastructure. The question remains is, with the amount of money that they're putting into this, will we start to see revenue generated from these economic decisions? I think we're going to see that more towards the end of 2026, but just something really to keep an eye on. And I think a lot of investors are digesting that right now. Are these valuations, are this CapEx spending, is it worth it? The final piece of this is just about labor markets and what to expect there. We're seeing a softening of the labor market over the last few weeks. Companies across the board, corporations from every aspect of the economy are shedding workers. And we need to understand if this is going to be a beginning of a trend or really a one and done, and what to really expect from there. So these are really the keys that I'm looking for on the equity side. On the fixed income side, it's Fed, the debt, the deficits, and spreads are going to remain the focus. So as we head into 26, the Fed's policy stance will be the dominant force shaping fixed income markets in general and treasury yields in particular. With inflation stuck here at 3%, the Fed is expected to maintain a slightly restrictive posture rather than cutting aggressively. Inflation being stuck at 3%, the sticky inflation narrative is really going to define what the Fed is going to do as much as what the labor markets are doing going forward. Current market pricing suggests rate cutting cycle could end by mid 2026 near 3%. So that's what we're shooting for, 3.5% on the Fed funds rate. A more accommodative stance, meaning a federal funds rate below 3%, will be required for Treasury yields to fall notably from current levels. As such, an unexpected slowing of economic growth or further decline in inflation are needed to justify more of a, like aggressive easing this cycle. So again, as I kind of go through all these things, or kind of how I tee up all these things, it's so important to note that there's a lot of uncertainty, which is what you're seeing in markets. Markets are trying to really digest and shake all this information. There's now when we've had nothing but tailwinds this year, we're finally starting to see some headwinds push against markets. We're at a bit of a crossroads as we digest this information and go into 26. And I'll end with this. While we can't predict the future, no one can. Us at Point 32, our team here is here to make sure that your assets are positioned in the right place. So understanding your risk tolerance based on your needs to figure out your risk capacity. And if you guys have any questions on any of this, if you guys want to get together and talk and review your goals financially, what your portfolio is looking like, maybe we are a bit overweight in a video, or maybe we're a bit underweight utilities, whatever it might be, whatever your circumstance might be. We're here at Point 32. We're here to help. Have a good day, guys.